Don't bet against the bull, I suppose. The stock market in North America has enjoyed quite a surge since April, and we're continuing to see equities in the U.S. and Canada hit all-time highs. I want to bring in Keith Buchanan. He's a senior portfolio manager at Globalt Investments to talk about the mood of the markets. Keith, it's great to have you with us. And obviously, it's been a very positive feeling on stock market trading floors over the last couple of months. What have you made of the enthusiasm around equities?
Well, good morning, John. Thanks again for having me. What the market's telling us at this point, with earnings growth where it is, accelerating next year another 500 basis points or so, and trading at 23 times earnings, is telling us there's some froth. And it's not just the valuation alone. We've seen some of them move into crypto, some of them move into meme stocks. It seems like that exuberance is spilling over into other risk assets that it gives us pause at this point in the cycle. Not that we don't believe the earnings or that AI is not going to transform how our daily lives happen. That's not where we stand. But we just think that the market is overpriced and giving us some concern. And as far as where we are in this cycle, earnings-wise and economically as well.
All right. Well, look, there's a lot of people who have started talking about what, they might think look like stretched valuations and maybe some unease on the horizon. So it might echo some of what you're saying. So how have you been thinking about positioning one's investment portfolio given the concerns that you have?
Right. These markets and these conditions can persist longer than those naysayers can perhaps even hold on to their convictions, frankly. So we're not in the camp of being short or underweight equities. We're actually a tad bit overweight. But we're cautious of adding more risk at this point in different parts of the marketplace. And what's really giving us a lot of pause right now is a different story you're hearing in the treasury market. The long bond is hanging on to this. The 10-year is right at 222 or so, 422 or so. And then even longer is up a little higher. That's not really telling the same story as 23 times earnings that have acceleration kind of priced into later part of this year as well as into 2026. So the juxtaposition of those two stories gives us pause when there's a difference between what the bond market is telling us and the stock market is telling us. As we're global macro, we have to take everything in. We tend to believe what the treasury market is telling us, and it's telling us there's some risk around. And equities aren't telling the complete same story. So that gives us some caution.
And, I did speak to Jonathan Corpina, who's been on the floor of the New York Stock Exchange for a lot of years. And he said, we're also entering what tends to be a seasonally choppy stretch for stocks, so something to be mindful of. But he countered that by, addressing the fact that given that we got through earnings season and generally speaking, the message from corporations was well received, given that, a worst case scenario on the trade front, at least in terms of economic performance, hasn't seemed to have truly materialized as of yet. And then given that we're potentially going to see some interest rate cuts by the Fed around the corner as well, and the Treasury Secretary, it's no surprise that he would be suggesting monetary easing, but he was on Bloomberg this morning talking about, the possibility of a 50 basis point cut in September. Jonathan was saying just those factors could maintain some momentum for stocks heading into the fall. What do you think about that? The idea of sort of fighting the tape against sort of some factors that investors seem to be hanging on to right now?
So as you mentioned, Secretary Besson was on this morning. 50 basis points this meeting isn't part of our base case. We're wary of what that scenario would indicate as far as the macroeconomic conditions that would bring the market to a more than 25 basis point cut in one point in time, and what in the past has led to those conditions. So we don't think things drop off that quickly. So we're not in the camp that really thinks that's a possibility, let alone a probability going forward. But the market's baking in 4 cuts over the next 5 meetings. Look, there are a lot of different factors that could come into play that really disrupt what is a market rally that seems to be pricing in a lot of perfection, if you will. Betting on a no-hitter is not something we tend to do. And when the market's leaning towards that type of scenario and we see risk abound, we have positions that are kind of outside of the traditional fixed income and equity sleeves. We're more hard assets. We have some precious metals exposure in silver and gold, and we feel like adds a lot of buoyancy to our portfolios, considering the risk that we see really facing risk assets across the landscape going forward. And then the geopolitical concerns, we can go, another 15 minutes about that.
Yeah.
So we're cautious about things, and we've expressed that in different ways in our portfolio. And that's kind of where we stand right now in this moment.
And we like baseball references, especially when Canada's team, the Blue Jays, are having a good summer so far. Hey, on the gold front, as you likely know, the Canadian stock market's at an all-time high. One of the key considerations is that there's more exposure in the Canadian stock market to gold than, on average, the S&P 500. And it's been interesting to me to watch that with this growing belief of a potential rate cut coming in September, that you're still seeing investors hang around gold. What, given that it sounds like you've been constructive on the metal, what do you think are the factors that might keep gold at elevated levels?
The factors that keep gold at elevated levels are what we've seen as far as the budget that was released as far as a month over the past couple of weeks. As we've gone through a reconciliation process, we kind of have our footing for what to expect from a budget standpoint going forward. The liquidity coming into the marketplace isn't slowing down in any point in time in the very near future. We feel like that's the story that gold is telling us, as well as, of course, that has inflation that lends itself to inflationary conditions, not necessarily results in inflation, but it does lend itself to conditions that might hold inflation up for longer. We feel like that's what the long bond is telling us as well. So gold kind of fits all of those, answers a lot of those questions that we have, that we're scratching our heads about, as far as the fiscal, monetary, and geopolitical concerns going forward. So yes, the Canadian market has a lot more exposure to gold-related assets. We wanted to explicitly express that view in our strategies, and we're sticking to that here going forward.
Keith, I'm almost out of time, but I just wanted to mention that Bloomberg does a survey, and they found that the respondents on average think that the valuation for the S&P relative to global stocks measured through the MSCI World Index is going to shrink over the next 3 years. That gap on valuations between U.S. stocks and global stocks is going to narrow. I didn't have a chance to sort of ask you about global equities, but what is your view?
Yeah, I mean, you can have that same argument about growth versus value, large versus small, U.S. versus international. The story's the same. What's driving U.S. has been the AI-driven names that have bolstered all of this market cap, historic levels of market cap and exposure within larger indices. But has justified that with cash flow earnings that seem to be fulfilling that promise, at least at this point. But the other parts of the world aren't necessarily driven by those particular companies. So we feel like that's a very AI, large cap growth, technology related trade that has really just dominated indices in a way that makes that divide between large growth in the US and everything else drastically wide. We think that is going forward, that can become sustainable. It can grow a lot larger. But we feel like the top heaviness of the market, whether it's, again, large versus small, growth versus value, or US versus international, lends itself to wanting to gain more exposure from a contrarian standpoint to those spaces that haven't really had the FOMO effect that you've seen in some of the AI-driven names. So that's something we feel like we can take advantage of. And we've been doing so and getting some of that exposure outside of the hottest places in the marketplace.
Okay, good to get your perspective. Thanks very much for that, Keith. Keith Buchanan of Globalt Investments.